She's the Democratic Congresswoman representing California's 45th District. Katie Porter, welcome back to Pod Save America.
Thank you.
It's good to see you. So today, President Biden is meeting with 10 Republicans to discuss their counterproposal of a $600 billion relief plan versus the Biden plan of $1.9 trillion. It's obviously inadequate. How should we be thinking about this process? What to your mind is the most likely way to get from this meeting to the most help for the most people as quickly as possible?
Pass the Democratic plan. I mean, I think it's important that Biden meet with these senators. I think this is an important opportunity to set a tone of more collaboration, of more listening, of more dialogue. But ultimately, these Republicans need to be told, because obviously they're not listening to their constituents, so it's up to the rest of us to tell them that $600 billion will only cause more economic harm in this country and create a deeper recession that is ultimately much harder to get out of and creates much deeper consequences. And this, by the way, is something that's being said by economists from all different kinds of backgrounds. The only disagreement on this really is coming from a handful of politically motivated people who, as we know, have no problem running up the deficit with tax cuts for their corporate donors.
Did they just start with a tiny number and then backfill what they cut from the Biden plan to get there? Like, the economists aren't calling for it. There's an option for Democrats to pass it through reconciliation without any Republican votes. What is motivating these Republicans to try to kind of jam Biden in this way? Is it purely just to undercut the new administration? Do they genuinely have concerns about doing enough to help people in this crisis? Like, what do you think is actually going on here?
These are some of my favorite questions. What do you think is going on in Ted Cruz's empty head? How would I know?
I'm not at Ted Cruz. He's not at the meeting. These are like your raw.
These other people, I can't say what they're thinking or what their motivation is because I'm not there. But let me just say this. This is not this smaller package with the kinds of cuts that they're making, including to state and local funding, including to some of the support for working families. This is fiscally irresponsible. The fiscally pragmatic, responsible thing to do here is to meet the needs of stabilizing our economy. So I just want to say it's really important that we as progressives champion this and set the record straight. The plan that we are putting forward, the $1.9 trillion plan that meets the scope and need of what COVID has done to our economy, is fiscally responsible. What these Republicans are doing is not. It is going to only deepen the recession and set our country on a path to being not globally competitive with other nations who have dealt with this situation, both COVID and the economic fallout, much better.
So I want to dig into that for a second, because I think so they're obviously trying to do this because they don't want to, because they're blanching at the price tag. But you're basically saying that if we don't spend enough now, the hole it creates in the economy over time creates a much bigger fiscal problem than spending enough now would create.
Exactly. And I'll just offer you a couple of examples. Our office recently released a report on the way that women are exiting and being squeezed out of the workforce as a result of COVID-19, plus the economic fallout that it's created. If we don't find a way to, for example, invest in childcare, invest in getting schools open, make sure there are deeper cuts in state and local government and funding, then all we're going to see is more women stay out of the workforce for longer. What does that mean? It ultimately means we're draining talent out of our workforce. We're making women, and particularly single women, women of color, low-income women, more likely to experience financial hardship, to need to borrow, to go bankrupt, to not be able to save for retirement. That is backwards. So what we need to do here is try to right-size the relief for the scope of the problem. And the longer this problem has gone on, the fact that President Trump did not deal with this well, did not get vaccines out, did not prioritize health and safety, the fact that we've chronically underinvested in public health is a great example of how this costs more in the long run.
So one piece of the crisis that you've been talking about is the toll this has taken on mental health, that there's a lot of people, we've failed to provide mental health services to enough people long before the pandemic. Now we have people in isolation. We have people who have long struggled with addiction alone and without their sort of support system. What are you trying to do to address the mental health crisis that we're in?
Yep. So one of the things that we did was pass at the very end of last year as part of the COVID relief bill, a bill that we have, bipartisan bill, to create more accountability for insurers to follow the law. Now, this sounds simple, but big companies, newsflash, don't always follow the law. It's cheaper just to break the law and see if you get caught. So the Affordable Care Act had a provision called mental health parity, meaning that mental health treatment should be treated the same way as other kinds of health treatment, whether it's for orthopedic care or something else. Insurers have not been complying with this. Anyone who's tried to, make an appointment for mental health, there are no providers in network. The providers don't take insurance because the reimbursement's terrible. There are unclear benefits. So this bill would try to make sure that we're delivering on that promise of mental health parity. But we have to do more than that. We also have to address the fact, as you said, that COVID has only deepened some of the mental health needs. This is coming through grief and loss of life. People have lost loved ones in this and lost them in ways that don't allow them to process. It's isolation, it's anxiety. And so we're also calling for increased funding in our bill, stopping the mental health stopping the Mental Health Pandemic Act. And I'm hearing this, by the way, on the ground from providers as I'm going about my day, seeing neighbors, talking to people in my community. They are all telling me that this is a huge problem, that they have wait lists for appointments, that there's a shortage of mental health care, including, and this is really important, the mental health needs of our healthcare workers, many of whom are being traumatized by what they're having to work with and through right now.
You've been tackling so many facets of this that I think don't get the attention they deserve. Another piece of this that you've been talking about is the pharmaceutical industry and the consolidation that we've seen there. Look, we've spent a year watching this failure unfold. There was an economic failure to provide people the resources they needed so they didn't have to work. We've seen the failed response by the previous administration. But science and the vaccine development was extraordinary. It happened incredibly quickly. It's a great testament to basic research investments from the public sector. It's a testament to these incredible scientists and what they did. But you've been looking at the way in which consolidation in pharmaceuticals might raise costs for prescriptions, but also stop innovation. Can you talk a little bit about the kind of consolidation that's been going on that may make developments like this in the future harder?
Yep. So we all agree that we want to have innovation in healthcare. We want improved treatments. We want improved outcomes. And that means that we need to create the conditions for innovation. One of those conditions is competition. And what we found is that what's going on in pharmaceuticals, as in many other areas of our economy, is an increasing problem with monopoly behavior and monopoly problems. So to the extent that these large pharmaceutical companies are gobbling up smaller ones, what they do is acquire the one thing they want, and then dump and cut all of the culture of innovation. And many of these smaller companies are the very entities that are willing to take risks, who are investing in, things that are further out from market development. And so it's really important that we have companies of different sizes with different levels of risk in our pharmaceutical community. And so what we show is we give a couple powerful examples in the report of exactly what happened when a small company making powerful innovations was acquired by a big company. It's not good. The big pharmaceutical companies are going to focus on the profits, on their shareholders. They're not going to focus on those long-term research and development initiatives. Big pharma spends more on lobbying every year than they do on research and development. Really important for people to understand that we should be pushing big pharmaceutical companies to put more money into R&D. Don't take them at their word. Make them show that that's in fact what they're doing. And none of this is to take away from the amazing work that scientists are doing. In fact, we want to support and encourage more of that.
So, it used to be, right, that there was Bell Labs, that these companies had these kind of long-term aspects of what they did, basic research, higher risk things, and that's sort of gone by the wayside. The federal government has cut back in terms of by percentage what they invest in basic research. And now what you're saying is basically these small companies that pop up to do something really risk-taking, to do something really innovative, to try to make something new, that they get gobbled up by these big pharmaceutical companies. And then the only thing they keep is the one thing they've already made, making it impossible for them to make something new.
Right. They shelve and actively kind of hold back the culture of innovation and the actual innovative projects that were going on at the small company. And so they're basically just, purchasing the entire thing to get that one thing that may be profitable, but then the rest of the initiatives die in the pipeline. And we've seen big pharmaceutical companies spend a lot of money making minor adjustments to existing therapies to try to hang on to patent protection and continue to make profit rather than investing in research and development to identify new drugs and new treatments.
And so what is the way to stop them from doing that? Is it more aggressive oversight by regulators around monopoly? Like, what's the way to intervene? Is it what legislation is needed?
Yeah, we put several things in our report about what we can do in this regard. But part of it is before we can even get to that point, we have to educate the public and educate our elected officials that this is a problem. We are also grateful to have, development of vaccines by these large companies, but we can't take them at their word that everything they're doing is always about innovation. They are companies. They have shareholders. What are they doing? They're doing what companies do. They're delivering profits to their shareholders. And I'm a capitalist. There's nothing wrong with that. But healthy capitalism means that you have that market competition. So in our report, we lay out a number of policy things that could be done. But a lot of this, the real barrier isn't that the policy solutions are so complicated. It's that politically, pharmaceutical companies spend millions of dollars every year to convince the American people that if they are subject to any market forces or any regulation, that they will stop innovating.
So speaking of capitalism, before we let you go, I did want to talk about GameStop. And I say that as one of their largest shareholders. I'm not. So a lot of the coverage has been about this being like the sort of ordinary person versus hedge funds. It also seems to be about risk and where risk is hidden in our system when it's working supposedly smoothly. What are the lessons you're taking away from this about what it says about the sort of health of our financial system?
Yeah. Well, first, and I'm sounding here just like my mentor Elizabeth Warren, but she's dead right. The stock market is only one measure of economic well-being or activity. Elizabeth and I have both seen this. You can have a sky-high stock market and also have consumers with sky-high debts who are filing bankruptcy in record numbers. So let's not conflate the stock market with an actual economic fundamental. Similarly, let's not confuse the price of a stock like GameStop, which was run up by manipulated practices, by kind of pump and dump, by retail investors coming together to flood the market, with actually GameStop being a good investment or not. And yes, some of the hedge funds that were involved, they were in trouble. They had a run. They couldn't make their requirements. They got bought by another company. They got a capital infusion. They had to basically sell part of their company. There are also hedge funds making a ton on this GameStop thing. And there are regular investors who are going to lose a lot of money on GameStop because at the end of the day, this is a company in trouble. This is not a company with sound economic models. And the real issue here is making sure that we're having regulators, an SEC that is doing its job of understanding the risk. This is not, despite the name Robinhood and however much I don't like the particular hedge fund guy on the other side of it, this really isn't a big versus small problem. This is a problem about risk and the fact that smaller investors are less able to bear that risk. And they've taken an awful lot of it on here.
Yeah, I mean, it seems like we do want a system where individual people have access to markets in the same way that big institutional investors do. But it seems that what would be the worst outcome is if all the bad practices in gambling and casino-like behavior of these large entities then trickle down to everybody, right? Like, it seems like what we want is we want to be open, we want it to be fair, but it's this strange situation where the more people behave like it's a casino, the more it becomes one, and the more risky and dangerous it becomes writ large, like for everybody.
Right. And look, to short a stock, you're basically betting on the direction of the stock share. You're betting on that it will go down. And if you're wrong, the consequences on the other side are huge, right? You can owe way more money than you put at risk in the first place. And this means you need to have a lot of liquidity. You need to have a lot of cash on hand to be able to meet that. You need to have other kinds of counter risk strategies. This is not something that individual investors are going to be able to do. So look, if you have $100 or $1,000 and you want to see what happens, by all means, short a stock. Maybe you'll win, maybe you'll lose. But understand, you might be on the hook for way more than that $1,000. And let me tell you, in all my years of dealing with families in bankruptcy and in financial trouble, I've never seen a hedge fund step up and say to a family, to a mom and dad driving a minivan with, a kid or two, hey, we'd like to buy part of your household and give you this money and invest in you. It's not going to happen. These consumers are just going to end up holding the short end of the stick. So I think your point, Jon, is exactly right. We want an even playing field. We want everyday investors to have access to strategies that will make them money and give them the opportunities to get the upside of capitalism. But the risk is also there, and we need to make sure we have a regulator who's doing the job of understanding the risk.
So two ideas that have been talked about recently. One is sort of addressing this more acutely, which is basically just making sure companies have more money if they're going to be engaging in short selling. But the other is something that's been talked about for years, which is putting some kind of a tiny tax or fee on trades to stop the high frequency trading that some of these hedge funds have made a ton of money on the other side of these transactions. What do you think about, what are some of the ways we should be thinking about this in terms of what Congress can do?
Yep. So with regard to making sure that there's adequate liquidity, that these entities have backstops, that's the job of the SEC, and it's as true for Robinhood as it is for any other entity, right? And if stock prices are going crazy, there's always the ability to stop the market, to freeze trades. What happened with Robinhood is exactly what happens in other contexts with other companies. When there's stock manipulation, whoever is doing pump and dump, whoever is manipulating the market, whether it's big or small, it's wrong, and there are market mechanisms to try to stop that. So with regard to the financial tax, I think there's a couple points here. One is we just need to think about where do we want to create the revenue that we need to invest in economic growth, right? And we have different places we could put that, right? Right now we have an effective tax rate on middle income families that's a lot higher than it is on many millionaires and others because of difference in capital gains rates and different deduction rules, things like that. The financial transaction tax is one place that we could look to raise revenue. And the larger issue, I think, is, because it's only large entities and complex entities that can engage typically in the kind of really high liquidity, high frequency, trading that's going on, we might think that tax would fall more on those big companies. But I think those are really two separate questions. There's a risk question, and then there's a tax question. I don't think we should be using the tax to try to deter the risk taking, if that makes sense.
Yeah. Before we let you go, you ordered Vanity license plates that say oversight for your minivan. Have they come, and will they qualify as a waiver to get you back on financial services?
No, so the license plates have not come, but they have been ordered, and I'm very happy to report it's very tough in California. There are a lot of other people that nobody else wanted the license plate, OVRSITE. So it's been submitted, it's being made, it'll get to me. I'll put a picture up as soon as I can figure out how to get the plates and get them on my van. With regard to the committees, I am thrilled to be on natural resources and to be on oversight. And part of it is we lost seats in the House. So I was the most junior member on oversight. I could have lost my spot. So I reallocated my committee preferences. I ranked them 1, 2, 3. And in the end, there were, I think 13 or 11 members who got waivers. I didn't. I was one of 2 who didn't. I'm disappointed not to be able to serve on financial services. But I think one of the things this whole thing has illustrated to me is how confusing and how not transparent some of these things are. The inner operations of Congress are to the American people. Like, the rules of the caucus are so complex that people can't even understand how we get on the committees we get on. And in that being very opaque and difficult to understand, then there's the potential for people to get confused and not understand what happened. So I would love to be back on financial services. There may be another opportunity either in a future Congress or later in this Congress. But in the meantime, I'm going to keep working on these issues. I spent my life working on issues of consumer protection, on capitalism. I'm going to keep working on this whether I'm on the committee or not.
Congresswoman Katie Porter, thank you so much for talking to us today.
Thank you.